In the spirit of Karnak the Magnificent, I will try to divine the answers to the questions found in these hermetically sealed envelopes. The answer is yes, yes, and the golden rule. Those who have the gold make the rules. And the question is APY different from APR? Does it matter, and how do they get away with it? I'm here today wearing a tie to try to build credibility for today's topic. What is APR, annual percentage rate? What is APY, annual percentage yield? And what's the difference between the two of them? As a preliminary matter, today's topic is for entertainment purposes only. If you want financial advice, please visit with your accountant or a qualified financial advisor. We all hear these terms frequently, annual percentage rate, annual percentage yield, and you probably say, potato, potato, right? They're the same thing. But that would be wrong. Let's get right to the bottom line. APR, annual percentage rate, is what you pay the bank when you borrow money. APY, annual percentage yield, is what the bank pays you. The difference between APR and APY is not as extreme as the difference between apples and oranges. It's kind of more like the difference between oranges and tangerines. And in this case, the bank gets the bigger, juicier orange, while the consumer gets the smaller, more bitter tangerine. And just like in Las Vegas, the bank always wins. They are not the same thing. APR is way more advantageous. Let's dig into this a little deeper and take a look at why. Imagine that you have had a mortgage, and this mortgage is in the sum of $300,000 at 5% APR. And for simplicity, let's say it's an interest-only loan. That means that every month you are paying the bank $1,250 in interest. Imagine you say, what if I sell this house, deposit the exact same $300,000 in a money market account, and collect 5% APY on that? I'll then withdraw that money and pay rent in the amount of $1,250. Now let's stop for a second and think in this age of sometimes bank failures, you would not want to exceed for a single person the $250,000 insured by the FDIC or the credit union group, unless you had two people on the account. So in truth, you would actually put this in two separate accounts, but for simplicity, let's say it's in one account. So going back for a second, you've been paying $300,000 on a mortgage, 5% APR to the bank, and your interest per month is $1,250. So once again, here's the scenario. You had a mortgage, 5% APR interest only, and you've been paying $1,250 in interest. You go and sign a contract to rent an apartment for $1,250. You deposit the money into a money market account, and you wait for your first month's statement and see what the interest is. You would think it would be $1,250, right? Wrong. In fact, the first month you're going to collect via APY $1,222.24, a difference of about $27.76 less than what you were paying the bank. So you're coming up short in paying your rent. In fact, if you withdraw the interest every month over the course of a year, after a year you're going to have come up short $333.12. How can this be? Well, here's the thing. APR is what we call simple interest. You take the figure of money that you have over a year, $300,000 at 5%. You do the math and you say $15,000 interest in 1 year, and you divide that by 12 and you come up with $1,250 per month. APY does not do this. APY is calculated over a full year's period and presumes that you leave your interest in the bank account. So with each passing month, you earn interest on the interest on the interest on the interest. So that at the end of the year, it calculates that with interest on the interest, you get 5%. Let's talk about this another way then. If your deposit of $300,000 was treated in the same way as APR, calculated in the same way as APR, you would actually only be getting 4.89% APR per year. Or, on the other hand, if your payment on your mortgage was calculated as APY, they would be getting 5.13% per year. You can see it's kind of like going to Las Vegas. The bank always wins. Now, this method of calculation has been around for a number of years. It was clarified in the Truth in Savings Act of 1991 and the following federal regulation, Reg DD. The stated purpose in that regulation is to allow comparison shopping among banking institutions where you might deposit your money. And for that purpose, I think it does work. You can see that an APY of 5.0 is better than an APY of 4.3. It's kind of like EPA gas mileage ratings. You may not really get 30 miles per gallon in the car you buy, but when you go shopping, you can pretty well assume that a car that gets 30 miles per gallon EPA is better than a car that gets 20 miles per gallon EPA. But why don't banks use the APR figure for both money when you pay them and when they pay you? It would be so much clearer. And I think the explanation is it makes them look better and it helps them make more money. And that's where we come around to this golden rule. The golden rule, not the traditional golden rule, but the golden rule, those who have the gold make the rules. In my lifetime, I've maybe given $100 or $200 to political figures. But in 2022, the banking industry gave slightly less than $600 million to politicians and their campaigns. And I think you can see why we are left with this confusing situation where when you pay the bank, you pay APR, and when the bank pays you, they pay you APY. You know, I've been around for a few decades, and I never really understood this distinction between APY and APR. Maybe it's that in my retirement years I have a little bit more time, and I took a look at a bank statement and figured out that the interest they were paying me in 1 month was not that simple interest, not the 5% that I would have expected. As consumers, I don't know how much we can do about this. Considering the political influence of the banking industry. But at least we can understand the difference and not be surprised when the interest in our statements is not what we initially would have expected. I hope this helps you understand the difference between APR, what you pay the bank, and APY, what the bank pays you. And I hope that you've enjoyed this video. Thanks for watching.